If you had a choice to save $6,000 inside a taxable account and end up with $235,000 after 30 years, or save your money inside a non-taxable account and end up with $432,000 after 30 years, which account would you rather save your money in? Of course, a non-taxable account that's going to give you $432,000, right? Let's say you have a choice in saving $25,000 over 30 years, paying taxes on it every year, and you end up with $843,000 at the end of 30 years, or save it inside a non-taxable account and end up with close to $1.5 million after 30 years. Which account would you rather save your money in? Of course, the account that's going to give you $1.5 million. So where's the first place your money goes when you get paid? First place your money goes is into someone else's banking system. And from there, you invest it, spend it, give it, or save it. And for most folks, this is where they choose to save their money. Now, what happens to your money sitting in someone else's banking system? Well, the lending institute pays you next to nothing, lends out your money, and makes a massive profit. And as soon as it leaves your possession, you lose all future value of that money, and you lose the ability to create tax-free, uninterrupted compounding interest. It's a permanent transfer of wealth away from your family and all future generations. Now, do you think it would be beneficial and profitable to leave your money inside your own system that functions like a bank and creates a tax-free cash flow for you and your family? Of course it would. If you knew where to keep this money and how to create the system, would you do it? I would hope so. Or would you rather leave your money in someone else's system so they can use that money to create a profit? Well, this system that we're referring to is referred to as a privatized banking system. And the first thing we've got to understand is banking is a process, it's not a product. And theoretically, you can use almost any financial vehicle for this process. You can use a workplace retirement fund, a brokerage account, a CD, savings account, even a shoebox. But we believe the best financial vehicle to use for this process is a high cash value, dividend paying whole life insurance policy. Now, there's a whole lot of reasons why we believe this. First of all, we're never losing value. There's no stock market risk like there is with a retirement account. It allows your money to work in 3 places at the same time. No other account allows this, gives us this capability. There's guaranteed returns. What other account gives us a guaranteed return? Maybe a CD, which next to nothing. Life insurance pays dividends. So while there's no guarantee of a dividend, the companies we use have been paying a dividend for 150 to 175 years. The cash value inside your policy is liquid, like your savings account. There's safety. Life insurance has proven to be the safest financial vehicle on the planet. It gives us the ability to create tax-free wealth. It's flexible. We control the money, not the bank, not the Wall Street, not the life insurance company, and not the government. There's no fees to use our money. So what this looks like, we get paid, it goes into our bank, and then from there, it goes into our high cash value, dividend paying life insurance policy. And from there, we save it, invest it, spend it, or give it. So we're not talking about using life insurance as an investment, right? We're talking about using it as a holding tank for cash instead of keeping it inside of a bank. And it allows us to capture the value of every dollar we pass through our system instead of shifting the future value away. Now, did you know that banks and corporations keep hundreds of billions of dollars inside life insurance? You can go look it up. It's called BOLI, bank-owned life insurance, and COLI, corporate-owned life insurance. They use it to pay expenses such as employee benefits and executive retirement plans. So back to our example, we're saving $25,000 over 30 years. And during this time period, we're paying taxes every year on our earnings. So over this time period, we're being punished for saving money inside of our savings account. So we are paying over $31,000 in taxes to the IRS just for saving money. Whereas inside the life insurance policy, the high cash value dividend paying life insurance policy, we're not paying taxes. So I'm going to take your attention to the cash available. So we're used to whole life policies where there's very little cash value. Well, this isn't that type of policy. This is a high cash value dividend paying policy, right? So year one, inside your bank account, $25,000 is available, but inside your cash value of your policy, there's only about $16,000 available. So it's like a business. You've got to capitalize on it. It's got to grow. You got to give it some time. So by year 8, there's $206,000 inside your bank account versus $204 inside of your high cash value dividend paying life insurance. And by year 9, there's $233,000 inside your bank account versus $238,000 inside your cash value. So we go to year 10, we're adding $25,000, but our cash value grows over $37,000. It's not a bad day. Go to line 25. We add $25,000 and our cash value grows by over $76,000. We go to year 29, we put in another $25,000 and our account grows by over $90,000. If you had a place to put your cash that treated your money this good, why would you not do it? Oh, and by the way, we've got a growing death benefit on this policy, as we do every policy. And inside of the bank account, we have no death benefit. Life insurance also has other benefits that I'll touch on in another video. But one of them is long-term care and critical care. So looking back at our other smaller policy, we end up with $235,000 and no death benefit. And that's inside the bank account versus inside the life insurance policy. We have $432,000 and almost $1 million death benefit, right? And one thing to note is, let's say you want to take this out in retirement as a supplemental retirement fund. This is going to continue to grow, no market risk, right? And we're going to get close to about $2.5 million out of this tax-free, right? We put in $750,000. We're getting out close to $2.5 million tax-free. That is not a bad return. That is a safe return. There's no market risk. So a banking system, you've got to have the ability to borrow from, right? So inside of our policy, we're not actually borrowing our money. We're borrowing against our death benefit. So that allows our cash value to stay inside the policy, continuing to grow uninterrupted. So we're leveraging the life insurance company's money to create wealth. So let's look at this from a case study. We've got 3 choices to buy a car. We can use the bank's money, we can use our money from policy, or we can pay cash, right? So we're going to borrow $24,000, paying 3% over 5 years. So we're paying the bank almost $1,800 or almost $1,900. So we're shifting over $25,000 from our balance sheet to the bank's balance sheet, right? And we've got $431 a month that is locked up. We have to pay to the bank or we get our car repossessed. Now, let's see what it looks like borrowing money from our policy. So interest rate is 4%. It's a little bit higher. So the monthly payment's a little bit higher. So total interest paid is more. It's over $2,500. But one thing with a loan from a life insurance policy is you dictate when you want to pay back that loan. If you got some bad months, if you got something going on, you lose your job, that's okay. You don't have to pay that loan back right away. But we want you to be a good borrower. Treat your own banking system the same way you would treat somebody else's banking system. So pay yourself back every month like you would a bank. And at the end of that 5-year time period, there's almost $30,000 sitting in that account. Right? And there's around an $880,000 death benefit. So now we've got a permanent bucket of money that will continue to compound tax-free with a permanent death benefit, right? So we actually ended up $3,357 ahead. So let's look at it this way. If we paid the bank, we end up negative $25,000. Or we have our own policy, our own system, and we pay ourselves that same amount of money. We're ahead, or we have almost $30,000, right? So the net difference is over $57,000. It's not a bad way to do this. Okay, I know a lot of people like to pay cash, but the problem is when you pay cash, you lose all future value of that money, right? So let's see what that looks like. We take out $24,000 from our account. We pay that to the bank, and then we end up putting the $442 back into the account every month, just like we did here, right? And at the end of that 5 years, we've got over $27,000 sitting in our account. But up here, we had almost $30,000. So by paying cash from our bank account, instead of paying cash from our policy, it cost us over $2,500. And we have no death benefit and no other benefits that life insurance provides. So let's look at our other example on a broader scale. Putting in $25,000 a year over 30 years, we're taking out $25,000 every 5 years to do whatever we want with it, right? We end up with almost $723,000. Let's look at our policy. We take out $25,000 every year, do whatever we want with it, and we end up with over $1.1 million. So because we saved money inside of our high cash value dividend paying policy, we have, instead of our bank account, we have over $416,000 more, right? So we call life insurance the and asset because we can have our money do multiple things at one time. So this continues to grow. Let's say we take that money out and we invest in real estate or the stock market. So guess what? We have this asset that's continuing to grow. We have this asset that's continuing to grow. And we have a death benefit that's continuing to grow. So our money's working in 3 places at once. Let's look at our last example. We got a 47-year-old putting in $1 million a year. He owns a trucking business. So at the end of that 10 years, he's going to have over $12.5 million cash value. Death benefits $21 million. His plans take out $700,000 in year 2, $3 million in year 6, $9 million in year 10 to buy some more equipment for his business. So he's going to borrow $12.7 million over 10 years from his policy instead of borrowing that money from the bank. So if you borrowed that money from the bank, he'd have nothing. No life insurance, no nothing. But this way, he's got cash value and a death benefit. So he's putting in $10 million total. He's borrowing the 12.7, and in retirement, he plans on taking about $823,000 a year tax-free from his policy. Now, if that money was inside of a taxable account, it'd have to be about 30 to 40% more. And where are you going to keep your money where there's no market risk? Right? So he's not going to lose this value. And total, he's going to take out about $16.5 million. And at the age of 90, he's going to have about $6.5 million death benefit. So who else knows about this? President Roosevelt, JFK, Ronald Reagan, Robert Kiyosaki, the Waltons, Rockefellers. They've got a family trust, and this strategy has helped them stay one of the most powerful families on the planet after 6 generations. J.C. Penney. This is how Penny's got through the Great Depression. Ray Kroc helped this build McDonald's. Walt Disney borrowed from his policy to start Disney World because he couldn't get a bank loan. Jim Harbaugh. This is part of his compensation plan through the University of Michigan. And there's a lot of coaches, professional and college, that this is part of their compensation plan. Banks keep hundreds of billions of dollars inside life insurance. So if they're keeping money in life insurance, why don't we just cut out the middleman? Right? Pampered Chef, Doris Christopher took out a loan against her policy to start Pampered Chef. So life insurance has other benefits as well. Essentially, it allows us to create a profit or positive arbitrage when you buy a house, a car, business equipment, or pay for a vacation. We dictate the repayment schedule, not the bank, not the life insurance policy. Funding continuation. Let's say you get a disability and you can't work. There goes your retirement plan. But with a life insurance policy, you can get what's called a waiver of premium. And essentially, the company continues to make your payments, right? You can use your cash value as collateral for a bank loan. It can reduce your Medicare payments and tax on Social Security. So this strategy can create hundreds of thousands of dollars, if not millions of dollars, tax-free throughout your lifetime. So my questions are, when do you want to start growing tax-free wealth? When do you want to start having more control over your money? And when do you want to quit shifting your wealth to other institutions? Thank you.